used car prices are finally starting to come down. In July 2022, used car prices fell by 1.6%. In August, used car prices fell by 4%, and in September, used car prices fell by another 3%. That means that used car prices are actually lower today than they were 1 year ago. Used car prices have fallen by 0.1% in the last 12 months. Now, that might not sound like that big of a drastic drop in used car prices, which it's not, but when you compare it to the price of everything else, from housing to gas to airfare, used car prices are actually falling, which has had a pretty big impact on the used car market. Like CarMax, which is a very large used car reseller, has seen their profits plummet, and this has caused their share price to tank. Why? Because when CarMax was buying used cars from people, they were paying a premium, that way they could have more used cars, and now the used car prices are falling, they're not able to sell these cars for a big enough profit, which means that they're losing money. Even Cathie Wood, the founder of the ARK Fund, has chimed in, and she said that the used car market is on the verge of a collapse. There are three main factors that are contributing to this new shift in the auto market. Number one is all the price hikes that we saw on cars, new cars and used cars over the last couple of years. Second, interest rates rising so quickly. And third, electric vehicles. People want more electric vehicles, and so people are choosing less to buy used cars and rather paying more for a new electric vehicle because people's demand preferences are changing. Let me start by talking about price hikes, because in the last couple of years, we have seen new car prices grow by around 20%, and we have seen used car prices grow by around 50% in just around 2 years. So now, if you want to go out and buy a used car, it's very expensive. And this naturally can lead the used car market to a correction, because when you see the price of anything grow so significantly, so quickly, you can see a correction happen. Well, now, when you couple all these price hikes with the growth in interest rates, that can cause prices to come down, because most people don't buy a car with cash. Most people are financing their cars. And so when you have prices of cars going up with very low interest rates, people can justify the higher prices of things because they say, yeah, the amount of dollars I got to borrow is more, but I paid less in interest, so it doesn't cost me as much. Well, today you're borrowing more dollars and you're also paying higher interest rates, which means you're borrowing more dollars at a more expensive rate. So it's going to cost you significantly more, which is why people are opting to buy less cars. To kind of put this in perspective, before the pandemic, Ford was making about $700 billion a quarter on their lending unit. Now, today, they're making about $1 billion of profit a quarter from their lending unit, because people have borrowed so much more dollars to buy cars, and so it has been very profitable for auto lenders up until now. And if you look at this chart, which shows you interest rates on auto loans, you can see that, well, auto loan interest rates have been skyrocketing. So if you start piecing this together, you can see that the cost of owning a car is more expensive today. And if you couple this now more expensive cost to own a car with everything else happening in the economy, where now your rent is more expensive, you have gas that's more expensive, you have flights that are more expensive, people are now looking at their entire financial portfolio and they're saying, you know what? It's not so important for me to go out and buy a new car and start increasing the amount of money that I got to pay for my car, because life is so much more expensive. So people are just turning away from the idea of buying a car because I'll just drive my car for another year. Big deal. Now, my team has covered this in Market Briefs, which is my free financial newsletter, but a big recession indicator is auto repossessions. Because when people start to struggle financially and you start to see people struggling paying their bills, the first thing that they stop paying isn't their home, it's their car. Because people would much rather lose their car than they would their home. And so auto repossessions can be an indicator for a slowdown in the economy, because when people start struggling with their money, they stop paying their car first. And if you look at auto repossessions in 2022, you can see that month over month, auto repossessions have slowly been creeping upwards. Like, take a look at this chart. you'll see that the red line is auto loan defaults. And in 2022, you can slowly see that auto loan defaults have been rising. Now, if you do want to stay up to date on what's happening in the top finance and business news like this, then you can join Market Briefs. Again, Market Briefs is my free financial newsletter where my team is breaking down what's happening in the financial markets. That way you can make smarter decisions with your money, especially if you are an investor. So if you want to be aware of what's happening in the financial markets and make better decisions, you can join Market Briefs for free. And I got the link to how you can join Market Briefs down in the description below. So now you have car prices that are very high, along with very high interest rates, causing the prices of cars to go down. And now when people have so much debt on a car, which is dropping in value, you'll see more and more people that become underwater on their cars, which then ultimately leads to more auto loan defaults and auto repossessions. And if you dig a little bit deeper, who are the people that are getting repossessed the most on their cars? Well, it's millennials and Gen Zers. And then we have people's preferences changing on what type of car that they want, because people are looking at gas prices saying, I don't want to keep paying $100 to fill up my gas tank. And then you have other people saying, I want to save the world, so I'm going to drive an electric vehicle. Whatever the reason is, more and more people want to drive electric vehicles. That means you have less people that want to drive a used gas car. And this has been changing the market for used cars, because slowly more and more people have been wanting electric cars, and you can't get as many electric cars used. So more and more people have been working to get a new electric car, which is changing the market for used cars. Now, all these things together have a few different implications. If you are in the market for a car, it might be worthwhile, especially if you want a used car, it might be worthwhile for you to wait a little bit, because if interest rates continue to go up, again, that's an if, but if interest rates continue to go up, the prices of used cars should, in theory, continue to fall. So you should be able to get a bigger discount if you wait another 6 months or another 12 months to buy a used car. Second, if you are in the business of selling used cars, well, it is going to continue to hurt your business if interest rates continue to go up, because that means people are going to have a tougher time affording used cars. Third, in terms of the economy, as interest rates go up, it is going to cause more auto loan defaults, because as car prices fall, more and more people are going to become underwater on their cars. More and more people are going to struggle paying their bills, because when interest rates go up, the economy slows down, which means people lose their jobs. As people lose their jobs, you're going to have people that can't afford to pay their car payment. And so all of these things coming together would lead to more auto loan defaults, which would also cause the prices of used cars to fall. Fourth, you also got to pay attention to the Federal Reserve Bank, because everything that I've said thus far relies on the Federal Reserve Bank continuing to raise interest rates. As of today, as of the time when we're recording this video, the Federal Reserve Bank is continuing to say that they're going to raise interest rates. Now, everything is a contingency, because you never know what the Federal Reserve Bank is actually going to do. Maybe 3 or 4 months from now, they're going to change their stance, and maybe then they start cutting interest rates. If they start cutting interest rates, then you could see the opposite happen, where you see car prices go up even more, where you see more people want to go out and take advantage of the cheap debt again. So this is where there's a little bit of that prediction factor, where we don't know what the Federal Reserve Bank is going to do. But if the Fed continues to raise interest rates, you can expect that to hurt the auto market. You can expect that to hurt the prices of cars, which can create better opportunity for you if you want to buy a used car in the future. So the entity you want to pay attention to is the Federal Reserve Bank, because they're going to tell you which direction the economy is going. And if the economy is going down, that means these asset prices, I don't like calling cars assets, but for the purposes of this topic, the asset price, which is this car, would continue to fall. These types of economic and asset booms and busts are a byproduct of our credit-based economy. And the way that it works is, well, the economy starts to grow. People are able to borrow more money, because now you're making more money, people have more jobs, you're able to qualify for more money, so people spend more money. This then helps stimulate and grow the economy even more,